Next, we're going to move into the master budget. And this is the culmination of the budgeting process. It's not the beginning, it's the end. We start with all the plans on how much we're going to sell, what are the needed expenditures for the overhead departments, how do we think we're going to be able to purchase our goods, and our vendor relationships. All those are precursors to the budgets themselves. We group all the activities into budgets, and then we pull those together so that we have one overall budget that can be broken down into specific activities by department. And ideally, it coordinates and shows the financial outcomes of the operational plans that underlie them, and it would cover a given set of period. The major goal is to ensure the smooth functioning of business throughout the budget period and hopefully be a good guide for next year's activities, both before we enter the year and as we go, and by way of doing budget versus actual analyses. There are 7 steps to budget process for a merchandiser. It will be more complex for a manufacturer, as we saw in our inventory accounting. So we're going to start with this because it shows the overall process for any budget, and it's the simplest of budgets. First, we start with the sales budget because everything is driven by level of sales. If our sales are going to triple, we're going to have to account for that with our staffing at all levels of the company. If, however, our costs are expected to drop by half, it would ensure some major overhead items that will need to be cut because we're operating a much lower volume. So we start with number 1, sales budget. Number 2 is purchases budget. And this, you recall, is a merchandiser. So we're going to have to buy merchandise to sell. That's why sales drives merchandise budgets. Number 3 is selling expenses. Number 4 are general administrative expenses. And at this point, we have most of the expenditures. Then we pull them together into a cash budget because, as we saw, accrual basis is not necessarily the same as cash basis. So we need to do thinking on the economics, which is usually accrual basis, and then we tie it back to cash budgets because budgets are reality and reality is cash. Then we look at special budgets, and these could be things like capital budgets for major investments in property, plant, and equipment. Finally, we end with number 7, which are pro forma financial statements, and we'll look today at the income statement and balance sheet. So let's start with the sales budget. It's the starting point for the entire budgeting process, and we forecast sales revenue based on units and the pricing we expect to achieve. And we use our best available information. We're forecasting future market condition, what merchandise will be available for us to sell, what are the plans to promote and advertise to bring business in, and also to look at pricing policies that we might have and what that might mean for a competitive reaction. All right, let's start with our example. It's BC Carts, and this company distributes plastic carts to retailers. And for the month of June, they estimate sales of 9,000 carts at a selling price of $10 per cart and an estimated cost of $4 per cart. So let's go to Excel and start building our budget model. For the master budget, on the left, we just carried forward the information, and on the right, we're going to build the Excel. We are given total units of 9,000, price per unit of 10. Sales equals price times units. So that's $90,000. Normally, we wouldn't do a whole year or just 1 month. We usually do each month or each quarter. Next, we'll look at the purchase budget. This is the purchase necessary to support the sales that we just forecasted. You can see how futile it would be to estimate purchases before we estimated sales. We sometimes use the more formal term of merchandise purchase budget. And we consider our budget sales desired ending inventory because we often don't want to go to 0 in our budget in inventory because what if we're wrong? We don't want to be subject to a stock out. We often like to have some inventory on hand even though we believe that it is in excess of what we think we would sell. And finally, we have some estimates for what our beginning inventory, and so we can build up where we began and where we're going to end. In our example, BC Carts has a desire to have 20% of next month's sales on hand at the end of this month. We're going to forecast this month and next month, and the ending point for this month's inventory is based on next month's projection. At the beginning of June, we had 1,800 carts that are on hand from May, and each cart costs $4, similar to what we saw before, and sales are expected to increase 10% per month. In the month of June, it'll grow by 10%, and in July, 10%. Step 2, we see merchandise purchases. Here we have the forecast for the month. We were given 9,000 units, that was above, And then targeted ending inventory is equal to 20% of next month's sales. So that equals 9,000, which is this month's sales, 9 times the growth of 10% means we multiply times 110%, 1.1, times we only need 20% on hand at the end of June to accommodate the beginning for July. So times 0.2, and we have 1980 of our targeted ending inventory. If we're going to sell 9,000 and we want to end up with 1,900, then the sum equals the total we need to have during the month. We started the month with 1,800 units. That was also given. So the purchases are the difference between 10,980 and 1,800. So we'll need to buy 9,180 to accomplish our sales and our targeted ending inventory. Then in terms of dollars, everything's times $4. 9,000 times 4 is the cost of what we expect to be selling. And same thing, ending inventory would be at a $4 per unit cost. And the total needed would be 43,920. The beginning inventory was also at 4, conveniently. And so our total purchases will equal the difference, or 36,720. All right, so that's step 2. Step 3 is selling expense. We present expenses which deal with some distribution costs for the product. It could mean salespeople, could be servicing manufacturer representatives or sales calls, all the things necessary to expose our product and to close on sales. And we break these into variable and fixed. Variable are stated as a percent of sales or a dollar amount per unit sold, and fixed are fixed. They're regardless of the volume, we're still having to expend those dollar amounts, such as have a sales office, pay the salaries of your sales and sales support staff. So to our example, BC pays a sales commission of 4% on sales, and in addition there are other variable selling expenses of 1.5% of sales, and there are fixed expenses of depreciation, advertising, and miscellaneous in order to support the selling function. So let's hop to Excel. Step 3, variable costs are 4 and 1.5, 4% of what? Of sales. So we go back up here and grab sales. And both are a function of sales dollars. So commissions are 4% times sales, and miscellaneous 1.5 times sales. Total is the sum of those. Those are our variable costs. Next, we'll look at fixed costs. Fixed costs were just given. Depreciation of 3,500, advertising of 2,000, and 1,200 for miscellaneous. We'll just note here that depreciation is a non-cash expense. And that's important for later on because we're going to be doing a cash budget. So I'll even highlight it so we can see it more easily later on. So the total expenses are the variable costs plus the 3 fixed costs. So 11,650.